Well, hello, everyone, and welcome again to the podcast. And I'm happy for you to get to know today Yonasan Sanford. Welcome, Yonasan.
Thank you so much. My pleasure to be here.
Yes, and as I start with everyone, why don't you tell folks a little bit more about yourself and how you've landed where you've landed?
Sure. So I am a CPA and run my own practice for about the past 8 years now. Been a CPA for around the past 10 years. And I'm located now over in Israel. Spent about the past 12 years living in Pittsburgh, Pennsylvania. And a couple years ago, moved over here to Israel with my family. Still, all my clients are based in the US, the vast majority in the Pittsburgh area. And the focus of my practice is really on tax saving strategies and tax savings consulting for mental health practitioners, psychologists, psychiatrists, therapists, counselors, as well as some other professionals in various health related fields. But the strong focus is really on mental health practitioners.
Yes, yeah. And I know for a lot of us in these professions, of course, as folks have heard from me on the podcast before, is just most of us get very little, if any, business training or financial training and that sort of thing. And so when we make the transition into private practice in particular, being aware of tax strategies and taxes and all of that sort of thing is is important stuff. So where shall we begin here with just thinking about this topic? What are some
Yeah.
things that really stand out for you?
So I think the main areas that I wanted to focus on, and I think that would be the most beneficial for your listeners, a few areas. One would be, looking at the most important tax saving strategies for mental health practitioners. Another area definitely wanted to touch on was the biggest mistake that I see practitioners making when it comes to taxes. I also wanted to spend some time focusing on S corporations, because S corporations are, one of these things that everyone's probably, well, I don't want to say everyone, but a lot of people have probably heard about them. And especially now you see so many tax strategies and, so-called experts putting out information on TikTok and Instagram and things like that. And you're kind of never sure, is this really legit or not? So I wanted to spend some time on S corps in particular, and if we have time, maybe we could touch on bookkeeping a little bit as well. Maybe we'll start with, probably what most people are interested in, which is the best way to save money, to save taxes when it comes
Hmm.
to mental health practitioners. There's a few areas, and the probably the number one most important subject is what's called the entity choice for your business. So when you're starting out, as a new practitioner and you form a business, you have to form some type of entity with the state where you're practicing. So that type of entity could be the default status, which is called a sole proprietor. That's where essentially you're just kind of operating as you don't have any other separate business entity. Then you have forming an LLC is a common choice. If you're in business with someone else, you might form a partnership, or you can form a corporation. Those are typically, the four options of sole proprietor, LLC, partnership, or corporation.
Hmm.
And they each have different tax implications. So making sure you have the right entity choice is for sure probably the most single impactful tax strategy that is out there for practitioners.
Hmm.
And as I kind of hinted at already before, the S corp is a very, very common choice and a very powerful strategy for reducing your tax liabilities. And I
Hmm.
wanted to just clarify kind of off the top that an S corp, if you notice, was not one of the things that I mentioned, one of the entity choices. And
Right.
that's because an S corp is not a legal entity. There's no state where you can go to and form an S corp with the state. Rather, the S corp is purely a tax designation. That's something that you make, let's say, an LLC or a corporation with the state, and then you submit paperwork to the IRS and tell the IRS, hey, I want you to tax my existing entity as an S corp.
Mm-hmm.
So having the right entity choice is, like I said, is extremely important for a variety of reasons, but it can definitely impact your tax savings strategies as well, your
Right.
tax savings potential as well.
Yeah.
Um,
Yeah. So,
so
one of the things that, and this is a question that in the consulting I do with folks, that particular topic comes up. And I love the way you explained it, because sometimes it's hard to explain to people that an S Corp is not an entity of itself, but it's really a choice you have to make about how you want to be taxed.
right.
Um, at the end of the year or throughout the year or whatever. And, one of the things that I've heard, and hopefully you can help clarify this, is that you really, until you are making a certain amount of money, becoming an S corp might not be to your advantage. So you want to say some things about that?
Yeah, yeah. Let's jump kind of into the S corp topic, because there's a lot to discuss there, and I think it's very practical for a lot of practitioners. So, first of all, the question is, why does the S corp make sense for people? Why does the S corp, why is it a common choice? How does it work in terms of saving taxes? So, I don't want to bore listeners and get into too much nitty gritty tax stuff, but
Mm-hmm.
the essential concept is that when you open your own business and you are self-employed, which is kind of the default status for a sole proprietor, or if you form an LLC, let's say, your profits from your business are subject to what's called self-employment tax. And the self-employment tax is the way that you, as a self-employed individual, pay into your Social Security and Medicare fund. As opposed to if you're a W-2 employee with a company, so you pay half and the employer pays half, and that's done
Mm-hmm.
through your pay stubs. When you're self-employed, basically the IRS says you have to pay both the employee side of those taxes and the employer side of the taxes. And that comes to roughly 14 to 15% when it's all said and done.
Mm-hmm.
And that's totally separate and in addition to any income tax that you owe. So on a tax return, every individual, if you're self-employed, you're going to pay both income tax and self-employment tax. It's all done on the single tax return you file. Now, that extra kind of 14 to 15% can really add up. If someone's making $100,000 a year, let's say, so besides for whatever amount of federal income tax they're going to pay, depending on what tax bracket they're in, they've got right off the top another $14,000, let's say, of self-employment taxes.
Mm-hmm.
So this is where the S corp comes in, because when you have an S corp, the way it works is that you are required to pay yourself a reasonable salary, what the IRS calls reasonable compensation. And that means that you literally write yourself a paycheck as if you were an employee of another company. You're going to get a monthly pay stub, or every 2 weeks, or whatever schedule you want to do it on, but you're going to get an actual pay stub and a W-2 at the end of the year. Now, the benefit is that, let's say a business, a practitioner is profiting $100,000 a year, and they determine, and I'll speak up about this a little bit more in a second, they determine the reasonable salary is going to be, let's say, $60,000 for the year. Okay. So on their $60,000 salary, they're still going to pay that 15% self-employment tax.
Mm-hmm.
But the other $40,000 that they've of profits that they have, because they were at 100,000 of profit, subtract your 60,000 of salary, and you're left with 40,000 of profit left over.
Mm-hmm.
So that 40,000 is not subject to the self-employment tax. And you can take that out as what's called, when you have an S corporation, you take out that money through what's called a shareholder distribution.
Mm-hmm.
And it's as simple as just transferring the funds to your personal bank account. It doesn't have to be anything fancy.
Mm-hmm.
But the point is that $40,000 of profit in that example is not subject to that self-employment tax. So, right off the top there, you have $40,000. Let's take 14% as the average savings. that's saving you about $5,600 per year. And that's going to continue to be the case every year. So that's in a nutshell, that's the reason why people do S Corps. There's really no other reason for it. The only
Right.
reason most small business owners elect S Corp status is to save on self-employment taxes.
Yeah.
Now, to get back to your question of when does it make sense to do an S Corp? So yes, there is definitely a certain threshold because of this requirement to have a reasonable salary. So what I see for most practitioners, in my opinion, is that you need to be at about $100,000 of profit before the S Corp is really going to start making sense or being beneficial to you. And again, the reason for that is because whatever your salary is, you're not creating any tax savings up until that amount. So if your reasonable salary is $60,000 and your profit was only $70,000, you only have a $10,000 gap there, which is not going to be worth it when factoring in the other complications and headaches of being an S Corp.
Yes, yes. So is an S Corp, is the proportion of profit that you're not paying yourself as an S Corp, is that taxed in a different way, or is that taxed at all? Or how does that work?
So yeah, that is still taxed, but essentially that's only subject to income tax, whereas your salary effectively is subject to both income tax and self-employment
Gotcha.
tax.
I gotcha. I gotcha. Yeah. So just depends on your tax bracket and all of that sort of thing as well. You have to factor all that in.
Correct, correct.
Yeah.
And what was done in the past, the past many decades, quite frankly, was people would form S Corps and pay themselves very extremely small salaries
Mm-hmm.
because again, that's how you create the savings. The smaller your salary is, the more of that gap you're creating that's not subject to the payroll taxes, the
Right.
self-employment taxes.
Right.
So you might have a business owner, profiting $250,000 a year, and they pay themselves a $20,000 salary. Well,
Mm-hmm.
if you're working full time, probably $20,000 is not going to be a reasonable salary, especially for a mental health practitioner or an
Mm-hmm.
accountant or a lawyer or for most
Mm-hmm.
self-employed people. So the IRS started cracking down on this, and they still do today audit S corporations specifically on the topic of reasonable compensation, which means that
Mm-hmm.
they're going to check and see how much time do you spend working in the business, what geographic area are you based in, because someone who lives in New York City is not going to have the same salary as someone who's based in Kansas City,
Right.
so they're going to check where you live, what industry you're in, what's the typical pay for your industry, how much time you spend, what's your level of expertise in the field. And based on all that, they're going to piece together what they deem to be a reasonable salary.
Mm-hmm.
So you need to be able to support how you as a practitioner arrive at your reasonable salary. You can't just say, well, I think $40,000 sounds good, so I'm just going to pick that number. You have
Mm-hmm.
to have good support for it.
Right. Is there a
But
formula that the IRS uses, or is that?
there's no real formula. It's kind of a combination of those factors that I mentioned. They're going to look at all of those things, and those are the types of things you want to document yourself to justify your salary. It's the IRS is probably not going to accept. Well, I searched for mental health therapists on Craigslist in the jobs section and or on Indeed or LinkedIn and found a
Mm-hmm.
bunch of jobs listing salaries at 45,000. So I deem that to be my salary. They're going to
Mm-hmm.
want it to be more detailed than that.
Yeah. 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 And I'm sure they would look at to your history. If you switch from to being an S Corp, they're going to look at what you've paid yourself in the past, I would think.
Yeah, yeah,
Yeah.
definitely, definitely.
Yeah. That's cool. Yeah. So, yeah. So, one of the things I know too is being able to explain to people the difference between an S Corp and a disregarded entity, which I know that comes up if you have an LLC. You want to
Yes.
explain that a little bit about that?
Sure. Yeah, sure. So a, a, a disregarded entity is the kind of official tax term for an LLC. So again, if someone's starting out and they form an LLC with whatever state your business is based in, and assuming that you personally are the only owner of that LLC, it's not some complicated structure where it's owned by another business or something like that, but you personally are the only owner of the LLC. So for federal tax purpose, that's called a disregarded entity, which means that that business does not file its own tax return. Instead, all of the business income and expenses get reported on the business owner's personal 1040 tax return on what's called your Schedule C. Mm-hmm. So that's a disregarded entity versus when you have, let's say, a corporation, then the corporation is going to file a completely separate tax return. So the S Corp is going to file its own separate tax return, reporting income and expenses. And then whatever profit is left gets what's called passed through to the individual. The business issues a tax form called a K-1, and the individual uses that K-1 form to enter their share of the profits on their personal return. Mm-hmm. So an LLC is a disregarded entity, whereas a corporation or a partnership, is not a disregarded entity. It files its own separate tax return.
Yeah.
And that's one of the important things to think about when you do an S Corp, is that it's not only about the tax savings. And this is a mistake that, I see a lot of people make, or there's a lot of advice out there on social media. Okay, once you hit this profit level, go ahead and do an S Corp. You're going to save money on taxes. Well, it's true. You may be saving some money, but there's also a lot of complexities involved with having an S Corp that you have to consider those complexities as well as part of the equation. So one of the complexities is having to file a totally separate business tax return, which means, frankly, your CPA is definitely going to charge you more money to file an S Corp return than just to file a personal tax return. So some of your savings from doing the S Corp are going to go out the window right there just from your increased tax prep fees. Another consideration that's very common is if you have, whether or not you're a group practice or you're, a sole practitioner, so to say, because if you have multiple owners in your practice, the S Corp gets extremely complicated and may not be the best move. And the reason for that is when you have an S Corp, any distributions, any money that the owners want to take out as profits have to be what's called pro rata, which means they have to be in line with the ownership percentage of each owner. So if you have two partners, and let's say they're set up as 40 partners, one owns 60%, the other owns 40%, and you decide you want to be an S Corp, that means any money you pull out of the business as profits has to be split 60-40. You can't say, well, I want to share this month profit 50-50. So that gets really complicated when you have multiple business owners, or if you have multiple business owners and let's say they each want to contribute significantly different amounts to their retirement accounts. That can also complicate things if you have a single S Corp. So and then the other factor I wanted to mention actually is location, because there are some states or even municipalities that won't recognize an S Corp. The most well-known example of that is New York City. If you're based in New York City has its own local tax code in addition to the New York State tax law, and New York City does not recognize S Corps, which means that if you form an S Corp in New York City, they're going to subject you to their regular corporate tax rates, which are high enough that it's almost certainly going to cancel out any benefit from being an S Corp. So I have a couple clients based in New York City that if they were, across the river in New Jersey, an S Corp would have made a lot of sense for them. But because they're in New York City, they're just kind of stuck with it and it doesn't make sense for them. So location can make a big difference also. And then the other important factor of the S Corp I wanted to mention real quickly is kind of increased bookkeeping complexity, or the need to have more proper books, I would say, because that S Corp tax return is going to have to report a balance sheet in addition to just an income statement. And you're going to want to have a proper set of books through something like a QuickBooks or, any other proper online accounting software. So, and there's going to be additional expenses for that as well. So again, you have, on the one hand, a potential for a lot of tax savings, especially as your revenue increases well above the 100,000 mark, and you can really stretch that gap between your profit and your salary number. You're going to have a lot of savings there. But on the other hand, you've got to factor in these other costs and complexities of being an S Corp.
Right, right. Yeah, I love the way that you explained that, because I think it's, as people have heard from me a good bit in the past, is just the importance of knowing your numbers and understanding how all of that works together. And also the importance of having someone like you, a professional that knows the complexities of the taxes and how it all interplays, is just, it's worth, you get the return on your investment of that, as I like to say, investing in having professionals that help with all of that.
Sure,
Yeah,
absolutely,
yeah, yeah.
absolutely.
Yeah, so Yonasan, one of the things that I know we talked about is that you had mentioned some of the big mistakes you see people make. What are those?
Yeah. So, so it's interesting, since my practice kind of evolved over the years in terms of which demographics I was working with, and going back about 5 years ago now, 5 or 6 years ago, I kind of got my first client in the mental health practitioner field, and that led to a lot of other referrals in the field. And I realized that I really actually enjoy working with mental health practitioners, and generally speaking, they've always been a pleasure to work with. And that exposed me to, on the one hand, a lot of opportunities to help them, and kind of on the other side, one particular mistake that I see happening a lot. And that number one mistake, believe it or not, goes back to that entity choice. And it's such a simple step. And that is, not the number one mistake I see is not forming an LLC when you start your practice. In other words, I see many practitioners that start with just being a sole proprietor because either they don't want the headache of doing the LLC and the additional paperwork, or they want to save some money and it may be cheaper to just start as a sole proprietor instead of an LLC. For whatever reason it may be, they start out as a sole proprietor, and then let's say 3-4 years into their practice, sometimes sooner, they're making enough money where they'd reach out to a tax practitioner to help them, and they want to save some money, and they heard on social media about an S Corp and that, they're ready to take this step. Well, unfortunately, if you don't have an LLC or a C or a corporation formed, you can't do an S corporation, right? It's impossible to take a sole proprietor and tell the IRS, I want you to tax me as an S Corp. You have to have an LLC or a corporation in place. Now, so that begs the question, if that's the case, so what's the big deal? Let's just form an LLC when I get to that point and I'm ready to start, with an S Corp election, let's say. Well, what I realized from working with my clients in the industry right away was forming an LLC at that point comes with one major headache, many smaller things, but one major issue, and that has to do with insurance billing. And you're going to know much more about this than I will, but I familiarized myself a little bit with the NPI requirement. And as all your listeners know, there's what's called an NPI 1 and an NPI 2. And you'll correct me if I say something wrong here, but the NPI 1 is kind of your personal number that stays with you as the individual practitioner. And the NPI 2 is tied to the group practice itself. So what I found was that if someone started their business as a sole proprietor and now they want to form an S Corp, but they don't have an LLC, so they're going to have to form an LLC and that LLC is then going to most likely have to get credentialed. It's going to have to get an NPI-2, which can be an awful process, apparently.
Mm-hmm.
For
Mm-hmm.
many of my
Yes.
clients, their insurance companies did not want to re-credential them. And, their whole billing process got essentially kind of slowed down significantly. And
Mm-hmm.
this dragged on for 4, 5, 6 months as a result of not having had that LLC when they initially started. So
Right.
it sounds like a kind of a silly thing, but it really, whenever I talk to someone and a new potential client, and they tell me they're making X amount and they're ready for an S corp, and I ask, do you have an LLC? And they say, no, I'm just a sole proprietor. It's always like, oh boy,
Uh-huh.
here we go.
Yeah. Right.
This is not going to be fun.
Right.
um, and it's a bit of a shame, because contrary to what you might hear on social media, there actually is absolutely zero difference from a tax perspective in terms of deductions or anything like that, tax credits, between being a sole proprietor or an LLC.
Mm-hmm.
So even though you may hear people on TikTok say, well, if you form an LLC, now you get to deduct this, this, and this. The truth
Mm-hmm.
is that anything you can deduct as an LLC, you can also deduct as a sole proprietor. So
Right.
there's literally no difference from a tax perspective when you start out of being a sole proprietor versus being an LLC.
Right.
But if you start as an LLC, then down the line, whenever you're ready to do the S corp election, it's a very easy process to do that paperwork. You can even retroactively do the S corp election to the beginning of, for sure, the current year that you're in, and potentially even 2 or 3 years back, depending on the situation. But you have to have that S corp in place. So doing that as your step one just sets you up for a lot of success down the road.
Right. Right. Yeah. And I agree with every bit of that. And the other thing for people to take into consideration is just creating a legal entity gives you a little more protection as well. I mean,
Yes,
as far as if, worst case scenario, somebody were to be sued, and and if their practice is an LLC, they can't, in most states, in most cases, they can't really go after you individually, your individual assets. They can only go after your business assets. So I mean, that's
that's correct.
you know fortunately in our business that doesn't happen too much, but it is a possibility in that sense. Yeah.
Yeah. Yep.
So
And that's absolutely another key point that I often bring up, with clients thinking of doing, well, what type of entity should I form? So, that's more of a legal consideration than a tax consideration, but it's
right.
100% correct that generally speaking, you will get an extra layer of protection just purely by having that LLC. And that's important, especially today, because think how many practitioners over, since COVID started, especially, how many practitioners are now working from home on a regular
Mm-hmm.
basis? This
Mm-hmm.
has kind of become the norm for most practitioners.
Yeah.
And if you're working from home and you don't have that LLC, and God forbid someone sues you, well, like you said,
Mm-hmm.
your home could be potentially at risk there in a lawsuit, and your car. And so it's
Yeah.
it's just a smart move from a lot of different perspectives to form that LLC, and
Yeah.
it's not that expensive or complicated to do.
Right. Right. I know when I formed mine, I was able to do it all online, just through the state. I mean, it's just a matter of filling out a few forms and then paying the fee. One thing I will mention is that it's probably a good idea to talk to an attorney at some point with that, because you're supposed to have a, oh shoot, what is the name of it? It's just a document that says how your LLC is
Yeah,
run,
the
even though you're the
articles of
only part.
the
Yeah, yeah,
articles
articles
of
of
incorporation, or every
yeah.
state calls it something different, but yeah,
Right, right, right. And so,
yeah,
but yeah, so, well, yes, Yonasan, I have to be respectful of your time. And this has been a great conversation. And I think hopefully just really helpful for people. Tell folks how they can get in touch with you if they want to find out more about your work and what you do and that sort of thing.
sure, I appreciate that. Yeah, I didn't get into some of the other strategies as well
Yeah.
for therapists. There's
Yeah.
a lot of other good deductions out there, but I'm happy to talk on an individual basis with practitioners also on some of these strategies. So my website is brookbayconsulting.com. That's BROOKBAY. And then, especially for your listeners of the podcast, I made a special appointment link for them to do essentially a free tax consultation where they can upload to me, the most recent tax return and or their financial statements from their practice. And I'll kind of do a free tax review to see, are you taking advantage of the most tax savings opportunities that are out there for you? And, kind of do an analysis of the tax return in that sense, or your financials. So the link for that will be calendly.com/Yonasan/podcast. My pleasure to have a free
Yeah.
consultation with your listeners.
Oh, well, that's great. That's very generous of you. It's such a pleasure to meet you, and hopefully we can have another conversation again.